Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome, welcome, welcome. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. We're independent. We're a fiduciary. We are a registered investment advisory firm. If this is your first time listening, welcome. If you are a repeat listener or catching the show on the podcast, welcome back. Thank you. I love to see the downloads doing exactly what we want them to do. A couple things on Kuhn Capital Partners, if you're not aware. We believe in being bold. We believe in being disciplined. We believe in being results-oriented. Our job is to make sure that we're creating lasting positive outcomes in your life, and especially when it comes to, certainly when it comes to investing, when it comes to retirement income planning. Those are our areas of focus. Generally, we work with individuals that are 50 and older, those that are nearing retirement or in retirement. So if that is you and you have any questions regarding your current portfolio, your current future income, the economy, concerns, then we want to have a conversation. So you can set that conversation up. It's simply a complimentary call with myself, and we'll listen to what you're doing, and we'll share with you if we can help you or not. So give Paige a call, 630-492-1912, 630-492-1912. Also, you can visit the website, kuhncp.com. I want this show to be about income distribution, income planning, what the industry is doing about income. It's very interesting. I think the industry has done a phenomenal job of, putting or educating rather, how you can accumulate your assets. While we don't agree with buy and hold, it's certainly a buy and hold philosophy. You can absolutely outperform the market. It can be done. Wall Street wants you to think that it can't be done, so their advisors can be, spending time talking with potential new clients rather than actually managing money. But what they haven't done a good enough job is a distribution plan. And that's a big deal. And I think no matter if you have $100,000 or $10 million at some point, I think you're going to want to distribute those assets, create some sort of a retirement income stream to fund really fund your lifestyle, right? Isn't that at the end of the day what we're trying to do? So the industry has it backwards. Advisors are still using stale data, stale software solutions to provide kind of retirement distribution strategies. Even worse, many people don't have a retirement distribution strategy, and that is very troubling, especially if it's not a written retirement distribution study, or not study, but a plan rather. So this show, we're going to spend a lot of time on distribution. So come back to the show, check out the podcast, because we're going to go over a lot of data, kuhncp.com. And we do podcast every episode. And again, if anything I talk about on the show this week that piques an interest, please make sure that you get with Paige and set some time up for us to have a conversation at 630-492-1912. So it's time in the industry to move beyond the probability of success in retirement when it comes to income planning. We have to look at moving towards an adjustment-based planning process, a planning focus that can drastically increase your retirement spending capacity. So I think the industry, if you've met with an advisor, generally what you're going to find, if you have any interest in, do I have enough money? Because that is a question that we often hear is, do I have enough money? And there's so much that goes into that question. Let's look at your spending. Let's look at kind of your lifestyle. Let's look at your goals, your objectives. But what the industry has done is they rely solely on software that was created 20 years ago. And it's Monte Carlo analysis. And certainly that's better than not doing any kind of planning. But, one of the main reasons that the success or failure version of retirement income planning that advisors share with clients, potential clients, was created was because it's simple. And in this industry, simplicity sells. That doesn't mean simplicity is good, however. You can make a case that simplicity is not good. Look at the 60-40 portfolio last year. Look at if you had your fixed income as your kind of buffer, your portfolio stabilizer, and you lost 13 to 30% of your assets last year. Well, there were strategies that weren't as simplistic that had some things that we had to discuss, but they would have done much, much better. So simplicity, unfortunately, in this industry sells, but that's not good. At least it's not always good for the client. And I think a case can be made that it's not good more than it actually is good. So the main reason that the success or failure version of retirement income planning was created, again, was simplicity. The main fear for the mass affluent investor is running out of money in retirement, okay? That, whether you have that preconceived notion, whether you have $100,000 or you have $10 million, generally speaking, that fear of running out of money is always an issue. Now, the larger, portfolios that you have, it may not be running out of money, but it may be, are we using our income? Are we creating our income effectively as far as the distribution side? Are we maximizing our tax-free or tax sensitive type strategies to create the most amount of income with the least amount of capital outlay, so then we can have the rest of the money, grow, obviously, for pure growth. So I think when you look at, investors wanting to know, and again, mass affluent, it can be $100,000 to generally a couple $1 million. Their main concern is, do I have enough money? And so the way the industry addressed that was to show them that the fear-based answer was either pass or fail. So they're able to understand, do I have enough income or do I not have enough income? But in reality, the goals for individuals in retirement is not just to, make sure on my deathbed that I have enough money. Certainly that is a goal, but it's to do things. It's to enjoy retirement. And again, certainly not to run out of money, but the pass fail of retirement planning is dated, and it's just not a good way to look at retirement income planning. And I think what it does is it really reduces the amount of income that, one can take, especially if you have under $2 million. You have to look at it differently. So I want, to really, again, give it a very basic feel and try to articulate the topic on the radio. It can be a challenge, but, we're going to do it. So 630-492-1912. If you want to have any investment related questions, get with Paige, 630-492-1912, and she'll set a time for us to talk. But consider this. Advisors today who are still using the probability of success software, which they're all out there. There's really three main providers, different names, but ultimately they have, the same outcome. If you're using the probability of success software in retirement income planning, I think you're failing clients. I think they are failing you. I think that they're limiting your income. I think they're setting unrealistic expectations of how much you have to save. So here's a really simple example. You have a 90% probability of success in meeting the funding your retirement income needs to hit your goals, in retirement. So if you have a 90% probability of success, what that means is you have a 10% failure rate. All right. Most people in the traditional software, anything above 85% is good. Well, here's the challenge. What if I was to tell you that 10% failure rate happens in year 2 of retirement. Well, all of a sudden, that puts an entirely different perspective on that 90% success ratio, right? So we have to really dive deeper in that failure bucket. In another way to look at it is, let's say we have a advisor that shows you a plan that has 70% probability of success versus 30% probability of success. So if you line up the 90-10 success versus the 70-30 success, which ones are you choosing? Well, inevitably, most people are going to choose, obviously, the 90-30. The 90-10. Well, we already said that 10% failure would come in year 2 of retirement. Well, that makes that plan look, drastically different. Most people will look at the 70-30 plan and say, I don't like that. Well, what if the 30% failure rate, what if all of the 30% failure rates of the plan came after year 100, age 100? Now, which would you choose? So clearly, in my view, the 70-30 plan is significantly safer than the probability of a 90-10 plan. So hopefully that paints a picture that there's a lot of issues when it comes to probability analysis, when it comes to retirement planning. You need a plan. You need an income plan. You need an income maximization plan. If you don't have one, again, call. Let's talk about why. They're so easy to run. 972, that's an old number, and is our Dallas office number. 630-492-1912, 630-492-1912, because the Monte Carlo simulations and the probability of success or pass-fail models, again, they were important innovations 2 decades ago, but it's clear today that retirement is not about pass-fail. That, today's retirees, they need direction, not scores. We have to move beyond the probability of success. We have to look at, when it comes to financial planning, again, I'll give you a real, simple example. If we have a pass-fail or a probability of success calculation that goes into an advisor showing you income plans, let's say your goal is $100,000, just hypothetically, for retirement income and Social Security, and let's say you're lucky enough to have a pension, and that makes up $99,000 of the $100,000 that you want guaranteed in retirement. Well, the report would show you a 0% success rate. The software and the processes are dated. They need to be changed, and we truly are leading that change, and we have adjusted to an adjustment-based income planning process. It just is the way to go. I think it allows the client to see when they can get raises. I think it allows the clients to stress test and to see when they may have to take pay cuts as far as, the income in retirement. Nobody wants to talk about that, but to do a one and done, probability of success and then hope that you're achieving these assumed growth rates in retirement is just a challenge. What if we have a stagflation environment where we see super high inflation, minimal growth over the next 5 years? What does that do to your plan? You probably have to reduce it. But what if we can quantify with guardrails exactly if we're getting closer to the need to reduce it? That's probably a better way to plan. And on the flip side, what if we see a 5-year raging bull market, right? That, the markets are up 30% a year. And now I don't think that's likely, but what if? Well, how do we know mathematically that you can actually take pay raises? And are we getting closer to that upper guardrail? So I think when you're working with a traditional advisor that defines success by making sure you have money in an account at some future arbitrary date, when ultimately your life expectancy is, that ultimately what most advisors are doing today. They're going to take your life expectancy, and then as long as you have $1 in that account at that time, then their probability analysis software says that you did well. Well, I'm not sure that that's the singular goal of retirement. I think there should be many goals, and I think plans will change. I think, the markets are going to change. I think your income needs to change. And, a primary goal, I think, is to fund not only your standard of living, but to do other things as well. And so if we can show you with guardrails when you want to spend, how much you can spend, sometimes you can take more, sometimes you have to take less. It's just going to be a much more efficient way to potentially provide greater income, and you're going to be able to see it. And I think that's the big thing. So if you haven't done a retirement income plan, if you want your income plan stress tested, again, it's complimentary. Let's have a conversation. 630-492-1912, 630-492-1912. We're going to talk more about retirement income when we get back, because this show is dedicated solely towards retirement income. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. We're a fiduciary, we're independent, we're a registered investment advisory firm. We believe in bold, disciplined, results-oriented investing. Our goal is to create lasting, positive outcomes, and that's our focus. And we continue to do that. And I think, as if you've met with us, if you had a conversation with us, I think we hear over and over again, we lead with education on the radio show. When people schedule a time to have a conversation with us and talk about their particular situation, or have, questions that may have, they may have arisen based upon something I said on the radio, one of the core main comments I get is, wow, you sound just like you do on the radio, and your advice is just as I would expect based upon listening to the radio show. So education is at the forefront of everything we do. This show is about retirement income planning, solely retirement income planning, retirement income maximization, tax efficient income planning. Obviously, it's you want to make sure that it's not how much you grow, it's how much you keep. And so there are many strategies that we're going to talk about today that you should hear. So with that being said, if you'd like to have a conversation with myself this week or next week or sometime in the future, certainly just give Paige a call, 630-492-1912, 630-492-1912. And she'll set that time for us to have a conversation. We do podcast every episode of the radio. We do have a national client base, so it's important for us to make sure that we have access to people who don't live in the Chicago market to listen to the radio show. And so if you'd like to listen to our podcast or this show that we podcast, you can do it at kuhncp.com. Click on the radio tab, or just go to Apple or whatever your favorite podcast is. We're going to come up there. So the first segment, we talked about the limitations of probability analysis financial planning. And I promise you that if you're talking about income and you meet with an advisor, they're going to run some sort of an income plan that gives you a pass-fail, that gives you a probability of success. Well, I don't know what a probability of success truly means. What is a probability of 87 or 93 or 85? What does that really mean? Is that the best way for a client or for an investor to maximize their income? What is the written plan to where you can take more in your retirement income, where you could actually benefit from the growth in the market? What has to happen to where you actually have to take a little bit less than the retirement income that we started out, because we may be in a 3 to 5 year or a big dip in the market? What are those guardrails? And so we believe that stale data, stale software, and the probability analysis of financial planning is just not the way it should be. We believe that, first off, when it comes to retirement income, it really, we have to change the conversation to an adjustment-based financial planning. When can I take more? When can I take less? What is my spending capacity. That to me is one of the greatest, ways to look at retirement income is how much can I spend? You don't have to spend it all. What if I don't want to spend it all? What if I want to spend more for these 3 years and then less later? And then let's, take a look at ultimately what that can do. Because, there's psychology that I found fascinating in a, just a little trial and error type experiment that has shown that people who were going to have an electrical shock, just a small electrical shock on their hand. So let's say we had 20 people that were going to absolutely get the small electrical shock on their hand. And then we had 20 people in the study that there was a 50-50 chance that they were ultimately going to get the electrical shock in their hand. So there, obviously there's a good chance or equal chance that you don't get it. What they found is they found the stress levels of those that knew they were going to get the shock versus those that knew there was only a 50-50 chance that they were the exact same. So what does that mean? I think it's the fear of the unknown. And when it comes to retirement income planning, that to me is what the challenge is in this industry. When you're using a pass fail one time at the beginning of a relationship of, working with an advisor, that could ultimately fail you because they're taking a look at just that singular point in time, that randomized, hypothetical scenarios that you either succeed or you fail. Well, here's the problem. There are outliers. Outliers happen. And I would think you would much rather plan for those outliers on a daily basis where you could see what your retirement income spending capacity is rather than all of a sudden being told, well, guess what? You have to cut your income by $1,000 or $2,000 or $5,000 or whatever amount that is a month. So I think when we look at spending capacity, I think, again, it's just a much better way to look at kind of, the retirement planning. And there's great software out there, and it's new, it's revolutionary. It's kind of like, the 4% rules. People still are adhering to that. I mean, my goodness, advisors are still creating strategies that they're just simply dollar cost averaging out of a portfolio to provide, the income that one needs. Well, that is crazy because, then if you're in a down period or down market, well, then you're actually taking more out. The markets are down. You're not taking more out, but you have to get a greater rate of return rather to get back to even because that's less money that, ultimately is going to be there to grow, in the future. And I would have to say that probably better than 50 to 60% of advisors. Now, there's no studies, but that's just kind of my anecdotal evidence of, when I talk with people, and I talk with hundreds of people, based on the radio show, that's their plan, and that's just not good enough. So 630-492-1912, 630-492-1912. If you want to set that call up, reach out to Paige and she'll set a call up for us this week or whenever you're free. Because again, we're talking about 20, 30, 40 years you may be in retirement. And traditional advisors are providing you with a probability of success or failure one time. And as we mentioned, that's at the beginning of the relationship. My goodness, how much can change in 10, 15, 20, 30 years, just in life in general, but certainly in the market. We had 87. We had the crazy run in the 90s. We had the crash in the early 2000s. We had the crazy run into 08. Then we had the financial crisis where, it was, the markets dropped 37%, peak to trough, they were down 50%. Then we ran into, 2018, then, historical rates of return, 2018, was negative. Then we still had a great 19 and 20 and then look at COVID, right? And then, still ended up positive for the year. But then, look at last year, the traditional financial planning approach of, fixed income, it could have done significant damage to individual investors because the markets were down, or in the bond market, generally anywhere from 10 to 35%. So much can change in a 20 to 30 to 40 year time horizon. And if you ask a financial advisor, seriously, how many of your clients have run out of money? They're 100% truthful when they tell you zero. And so, indeed, not running out of money, I would think most, clients don't have anybody that runs out of money, but, not running out of money certainly is critical in retirement planning. But for the masses, it's not about running out of money. It's not about running out of income in retirement. It should be more about having a GPS-like system to provide turn-by-turn directions when they are needed. And so that's how we look at retirement income planning. I think it's about the spending capacity. And I want to change the narrative on income planning, because I think if you're working with a traditional advisor, you're probably limiting how much you can actually take out, because these software programs, when they want and when they determine that you're going to have success, it's having money in account at your life expectancy. There's so much more that we can do during your living years, during your, hopefully they're all living years, but during your active years, again, if we can have guardrails of upper amounts that we can take versus lower amounts that we can take, I think we can adjust, and adjustment-based planning is just the more appropriate way to look at financial planning when it comes to distribution and income spending and retirement. Because when you can mathematically tell people when you can get a pay raise, well, all of a sudden, we're going to remove the uncertainty around when you have to take less, when you can take more, and this is monitored literally on a daily basis. Now, you don't need to look at it on a daily basis, but we go back to that study that I referenced earlier with the electrical shock, that those that knew they were getting it versus those that they had a 50-50 chance of getting it, the stressors in their body were the same. Well, I think, we look back to, well, what if you had a financial plan that was a pass-fail or a probability analysis plan like most do, and we went through an '08, or we went through a .com, crash? That's probably going to cause some stress. And yes, you may not run out of money, but that's going to cause undue stress that's just not needed. Where if you had a plan where we can stress test your current retirement income plan, your current retirement income needs, and we showed you that based upon not hypothetical returns, because yes, anybody can do randomized generated returns, but again, you have to account for outliers. And we can show you that, hey, in '08, when we had a 2-year terrible period in the market, that all you had to do was reduce your income by 5% or 7% or whatever that number was. Well, all of a sudden, we're removing that uncertainty. We're removing that unknown in financial planning and certainly retirement income planning. And that's probably going to allow you to sleep better at night. And again, on the flip side, if you ask an advisor, hey, when can I take more money out? I promise you, they're not going to give you a mathematical verifiable answer. And our rules-based planning software, and when we look at it as an adjustment-based planning, income planning software that focuses more on spending capacity, we're going to be able to do that. And again, the key is the guardrails. The guardrails. And again, the software updates it daily. You don't need to look at it daily. You may only look at it once a year, but it's our job ultimately to look at it daily and to let you know how close we are to either, an upper guardrail or a lower guardrail. So, the retirement income portfolio stress test is so critical today. Especially in these markets. Do I think we're going to see, and if you listen to the show, you know that I'm not necessarily concerned about a major crash in the market. I'm really concerned about low growth. I'm concerned about high inflation, high taxes, and a 2 to 5 to 7 to 10 year period where we see no meaningful net growth. After tax, after return, appreciable growth. That is my main concern. So we have to make sure that we are stress testing not only portfolios, but this show is really geared around income planning, but that we're stress testing your current income plan, or if you have 5 to 10 years left into retirement or to retirement, well, we want to stress test the plan that you think that you have, and we can do that. So give Paige a call, 630-492-1912, 630-492-1912. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. We're independent. We're a fiduciary, registered investment advisory firm, and we focus on making bold, disciplined, results-oriented decisions. Our goal always is to create lasting, positive outcomes when it comes to your money, when it comes to your retirement income planning, when it comes to paying less in taxes, whatever your goals, your objectives are. We want to make sure that we're adding value for you to meet those. Because if you've listened to the show in the past, you know that I'm convinced that most advisors bring very, very little value to a relationship. Their clients simply ride the market up, they ride the market down, and then ultimately they pay a fee for that right. So we don't believe that is it is money management. We don't believe it's the right money management, but it certainly is a style of money management in this market. I think you have to make sure that you have everything tested. You have everything stress tested. It's so simple to do. Software, that is cost prohibitive on your end. We make that capital investment so we can bring that to our potential clients, to our current clients, and whether it's on the income side, which we've talked an awful lot about today, or it's on the growth side. Again, those are things that we have to make sure that are being done. And it's very hard to go to a current advisor and say, hey, stress test my portfolio. I'm concerned, right? Advisors are prideful people, and they're going to probably tell you that, hey, don't worry about it. We have everything covered on the downside. Well, show me. And in this day and age, show me is the most important. And here's the best news. It can be done in 30 minutes. So it's very easy to do, and we can give you a really great report. And what we found is that those that have their portfolio stress tested, whether it's for growth or whether it's for income, once they see the results, it's going to do one of two things. It's going to confirm that they don't need to talk to us, and then the relationship is going to end. We provided a service, and we're perfectly fine with that because we know that we only want to help people that need help, and there's plenty of people throughout the United States that need our help. Or something else is going to happen, which people are going to be surprised, and they're going to be like, oh goodness, I didn't know that. I didn't know that this was what could happen, whether it comes to growth or whether it comes to your income. And then if that is the case, then you're going to be more open. You're going to listen to what we're saying more, and we can really dive in and have an intelligent conversation of why, your portfolio is not, doing as you expect it to do in down markets. Because again, you lose less, ultimately you make more. So with that being said, give Paige a call, 630-492-1912, 630-492-1912. You can listen to the radio show. As you know, we do podcast every episode, KUHNCP.com, KUHNCP.com. For those listeners who are out of state, which we have many, many, many listeners, throughout the country, that's how they catch the show. And again, if anything that we say, especially on this episode, the retirement income planning episode, somewhat technical, but hopefully it's not too technical. Again, just pass on that link and let them listen to the show. And hopefully if something resonates with them, they can reach out to Paige, again, 630-492-1912, and get on our calendar so we can have a conversation. So again, stress testing, I think it's important. It's everybody should do it. Institutions do it. Pension funds do it. 401k plans do it. Why don't you do it? Because when you look at bigger pools of money, I think a case can be made that they could withstand a low growth environment for 5 years, 7 years, 10 years, or they can withstand a early 2000s again, where, we're down 10, 13, 19%, 3 years in a row. You who may have $100,000 to $5 million to $10 million of investable assets, it might be different. And so stress testing is important, not only on the accumulation, the growth side, like we've often talked about, but also, and maybe more importantly, is on the distribution side. And the industry is playing catch up when it comes to financial planning on distribution, on showing somebody how you can have your income and how it can fluctuate, how it can go up, how it can go down. Again, it's not pass fail. It's spending capacity. It's adjustment-based planning, which we're going to lead the charge on. And we're really, really happy, with that, because I think, again, our job as advisors is to understand the cost and the benefits of how and where to fund your distributions to present to generate your spending capacity. We have to look at trying to maximize your after-tax distribution. So that comes with Roth conversions. I mean, Roth conversions we've talked a lot about on the radio show. Very simple to do, not a revolutionary concept. I mean, you take the IRA, you convert it to a Roth. What does that do? That is going to increase your income in that year. What if there were investments that you could then invest in with some other capital that could reduce or remove that additional income? And you may not have to pay any taxes to convert that Roth. There are strategies out there. If you're working with a big bank or a big brokerage firm, you're not going to have access to those. It's just the way that it is. When you're working with somebody that's independent, you have access to those types of strategies. Doesn't mean the strategies are good or bad. We're just taking a very basic concept of Roth conversions and trying to do it without you having to incur additional tax. How great would that be? Take a a taxable asset, convert it to, future tax-free, to where you're not paying any gains on the future, any taxes on the future gains. And, oh, by the way, we take it that extra step, which is probably the most important step. You invested in a strategy that has significant tax benefits that we can negate those additional income that was due. Again, those are the things that we're doing. 630-492-1912, 630-492-1912 if you want to learn more about that. Because our job is, again, there's one thing that is very, everything in finance is debatable, right? There's one thing that everybody agrees upon. We want to pay less taxes. And that is our job as advisors is to do that. And, almost always the independent firms can have more access to strategies that can greatly reduce your taxable income. So if you want to look at a Roth conversion, again, it may only be $50,000 or it may be $3 million. It doesn't matter the value. Let's pay less in taxes. So that's, ultimately our job is to educate on those strategies, that are out there. Because, again, we talked a little bit about psychology in that study earlier. The human brain is 10 to 12 times more worried about losing money than missing out on market gains. So if we know that, now that's not everybody. We have, clients who are super aggressive and don't worry about risk, but that's by and large, that's not, everybody out there. More people are concerned about losing money than they are about missing out on future gains. So we are guides. We have to be good guides where we know where you ultimately want to go. And when we look at that, good guides need to know, where were we guiding you? We have to know you. We have to know your goals. We have to know your objectives. We have to know what you're trying to accomplish. And, when we look at what a good guide is obviously the knowledge. Secondly, we have to see the landscape. What are we dealing with? What is your area of focus? Do you want to maximize growth? Do you want to maximize tax reduction? Do you want to maximize retirement income maximization? We have to know where the landscape is. What is the economy doing? We're in a very tenuous period of the market. We're in a potential period where we could see very little appreciable growth when you factor in taxes and inflation due to the current inflation rate. And that is, just reality as far as where we're at today. So we have to know what we're dealing with. We have to know you. We have to know the landscape. And then, third, we have to have solutions that we can break out when things go haywire. I think advisors generally react on the fly if something goes wrong, and that could hammer your long-term success. And when we look at, we bring it all back into, adjustment-based financial income planning, and when we can look at where we're at, in real time, as far as when do we have to start worrying about you taking a pay cut or when you can actually get a pay raise. That is the benefit of the adjustment-based planning. And unlike traditional financial advisors, we change and we can articulate mathematically, both positively and negatively when ultimately you may need to make a change. And I hope you agree that creating a retirement income plan based on adjustment-based planning, spending capacity is a much more efficient way than, just looking at kind of a pass fail or a probability of success, ratio. So we think we're radically changing how investors look at retirement income. We know we are, actually. The software is amazing. Can you believe it's done on a one page? So we can actually stress test your current portfolio. We can create the retirement income plan with all of the different accounts that you may have, Social Security, pensions, and give it to you on a one page, not a 50-page book that you'd probably never look again. And it's, as soon as you get out of the advisor's office, it's on the shelf. So one page, that's our focus. We want to make bold, informed, disciplined, results-oriented decisions. Our job is to create lasting positive outcomes, especially when it comes to retirement planning. We're going to talk about strategies and what individuals are using to generate income, talk about rates that we're seeing currently when we come back. So if you want to have a call this week or next week, just get with Paige. Paige will set that time up for us to have a conversation. 630-492-1912. 630-492-1912. More after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want to find outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. If this is your first time listening, welcome. If you're a repeat listener, welcome back. If you're catching it on the podcast, thank you. We like to see the podcast numbers do what they are doing, which is going up and to the right. That means we're educating to the best of our ability, which is obviously, something that we take very, very seriously. So anything I talk about or reference that you want to have an additional conversation about, please feel free to call Paige, 630-492-1912, 630-492-1912. And we certainly can set some time up to have a conversation. Clearly, the markets are challenging, and I thought for once, we don't often talk about retirement income, but I think, when the markets are, doing what they did from 2009 to 2020, and then really 21 as well, income is really simple because the markets are averaging 15% a year, and people, they don't necessarily need, they need, but they can get away with not having a income maximization plan that's written. And one of my main concerns, and I continue to hear it from individuals as well, is inflation rising, growth slowing for a prolonged period of time. And if you've listened to the show in the past, if you had bought Microsoft in 2000, it took you 14 years to get back to even. So what if we're in that period right now? What does that do to ultimately your income? What does that do to your ability if you have 5 years, 7 years, 10 years left before retirement, or if you're in retirement? What happens to the value of your asset base, and then what happens to the longevity of the income that you have? Because people, the markets are somewhat skewed, I think, right now as far as returns. And we say that because it's reported, I haven't done the math, but it's reported that if you take out the top 10 contributors of the returns this year of the S&P 500, it's actually negative. So think about that. You take out 10 stocks and the S&P 500 is negative for the year. So are you really getting that that diversification that you think? Because we love it right now when we see, obviously, the market up, for the year, depending upon, it not huge, but it's certainly positive and green, and we like that, near double digits. But you take out 10 stocks and the return is negative. I think that shows you that there are some issues there, and there are some issues that you really just can't control. And, we believe in, kind of a sleeve approach to managing money. Our protection sleeve, which we talked an awful lot about today, on the income side, and the protection sleeve on the growth side as well. That's principal protected. So can't lose money. I mean, I don't know how much more safe it can get for that. And any gains that you have, those gains are locked in each year. That is becoming very appealing to people for some money. And the current rate on that is gains anyways are up to the first 15% of the S&P 500. That's probably going to go down, but that's what it is today, and at least for the next 12 months. So that's obviously people find that very appealing. And then our growth sleeve, we have a growth mandate. We believe in individual equities. If you have over $100,000 and you're in mutual funds, we probably should have a conversation. And the last two buckets, most advisors are not bringing to the table. And I think that they're, probably two of the most important buckets, certainly in this market, our opportunistic bucket. And the opportunistic bucket is a strategy or strategies that try to take advantage of, short-term mispricing in equities, fixed income, indices, just short-term near, mispricing. And that, this market has been really great for those types of strategies, but most people don't have it. Most people are working with an advisor where it's simply a buy and hold strategy, and you don't get to take advantage of, this volatility. And then lastly, our cash flow / tax reduction bucket is, obviously, given where the market is, given where interest rates are, given where inflation is, where we think tax rates are going, those investors who want to reduce their taxable income, there's some phenomenal strategies. We can reduce, per $100,000 invested, somewhere in the neighborhood of $60,000 to $70,000 can be used to reduce your taxable income, offset capital gains, offset ordinary income, 1099 income. You sold a building, a business, etc. I mean, it's substantial, and you can get 10% distributions on that strategy. So the sleeve approach, we think, is very dynamic, and it really encompasses what we talked a whole lot about this week on the show was, kind of what is wrong with the industry when it comes to cash flow management and trying to predict what somebody can or can't take, or a probability of success. I mean, that's just stale data, and that's old. It's crazy to say, but 2 decades old, and people are still using it as a kind of a pass fail. And I think what that's doing is really setting incorrect expectations for all of the reasons we talked about. But if you're just joining us now, I think when you look at the adjustment-based spending that has guardrails on the upper and lower end of what you can take out, I think we can have you take out more money, and you're not going to have, if the markets drop, you're not going to have to, all of a sudden, get hit with, hey, your spending needs to stop like now. I mean, that's what happens when you have a pass fail, or even worse, you don't have a written income plan. So what people are using for, to generate income, I think fixed income. So many people obviously have fixed income. Last year was just the worst year on record in many of the fixed income asset classes. Unfortunately, most advisors didn't protect their clients when they should have. If you lost a bunch of money last year, please, in the fixed income space, let's have a conversation. 630-492-1912, 630-492-1912. I want to share with you our repair strategy. But, fixed income certainly, has its place, or something that can mimic it while reducing the interest rate risk. And what we're looking at is, short-term bank notes. All the banks offer them for the most part. JP Morgan, Chase, Bank of America, Citi, Morgan Stanley. I mean, all the big banks are going to offer short-term notes. And they take a minute to understand, but they're rather simplistic once you hear it once or twice. But it's we can get close to double-digit distribution yields that in some instances JP Morgan had a principal protected note where your principal was actually protected by the bank, of course, not FDIC. Well, was it? No, that one wasn't FDIC protected, but JP Morgan obviously is arguably the best bank in the world. And if we can get short-term bank notes that are in the 1 to 3 year period that are paying 10 to 12%, clearly that makes some sense because they're not interest rate sensitive. They're not going to be affected directly by interest rates. Now, it's a bank note that's a little bit different than a bond, so we have to go over that clearly. But 1 to 3 year notes from the top banks, we can get really 10 to 12 is kind of a good general area that we can get. And then so that obviously is, if we're in a stagflation and period where we're in a sideways market where we don't see a lot of growth or maybe any growth, we see ups, we see downs, but net we don't get much further ahead. It's nice to have cash flow coming in. That's one of the big differences between kind of the more money you have, I've found, to invest, you're more focused on cash flow. You're focused on, investments that are going to pay you regardless of what's going on, in the market. And so for people who are looking to generate above average income, banknotes are phenomenal. The lifetime income story on the annuity space, if you have a few years to let it cook, so they're not super competitive. Well, they're good. They're average for immediate income. I think we can get, if you need immediate income, I think we can get better, distribution yields. But if you have, 1 to 5 years where you can, well, really 5 years where you can put aside some money in an annuity that has a lifetime income component, I mean, those are really strong. You can get distribution yields that are guaranteed for life in many instances, in the 7 to 10% range if we have market growth. So the way that they work is the more market growth you have while you're not taking income, the more your future guaranteed lifetime income is going to be. So, again, that you have 5 years to let it cook. I don't know that is incredibly strong. Now, it has the word annuity in it, of course, but it's not an annuity like before where you don't lose it, it goes to the insurance company. I mean, these are about as client friendly as you can get. I think people just need to get over, the word annuity. All that being said, hopefully everybody had a great week. Hopefully you picked up a nugget or two that can help you this week. Any questions you have, always please call Paige, 630-492-1912. She can set some time for us to talk this week, 630-492-1912. We'll be back next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.